On July 4th, President Donald Trump signed into law his big, beautiful bill. Well, here's our small, we think, beautiful summary. One thing that's important to cover with this bill is it is big. What I mean by that is close to 1,000 pages. To put that in perspective, President Trump passed the Tax Cuts and Jobs Act when he was in office the first time. That was around 200 pages. Not only is this bill big, but a lot of the details have not been hammered out, which is common with these tax bills. One of the things we saw with Secure Act 2.0 was there was provisions for 529 plans to take a portion of that and put the unused funds into a Roth. It took over a year before we got a lot of the details of what that would look like. Similar to Secure Act 1.0, we learned about the 10-year rules, but we didn't realize if that was going to be a lump sum at the end of 10 years, if there was going to be some form of an RMD or required minimum distribution over those 10 years. Those provisions typically take time. The reason why is different agencies in the government have to give us the details of those provisions. The most notable in this bill is what's being referred to as the Trump accounts, or the accounts for newborn children. A lot of the details of that are unknown at this point in time, and most experts I've heard from are projecting somewhere in mid-2026 before the Treasury Department really kind of figures out the details in that. With that being said, let's get into the most important aspects of this bill. Again, this is a small, beautiful summary. The most important part is the Tax Cut and Job Act brackets have been made permanent. What this means is for most taxpayers that we work with, and most taxpayers I've talked to, and over 50% of taxpayers should not have a major impact to their tax bill. Why? Because the tax brackets are staying the same. If this did not pass, the Tax Cuts and Jobs Act, we're going to sunset at the end of this year, meaning for a lot of people, they were going to see a major increase in their tax bill. It's important we're talking about this. This is general. You have different tax situations, so a lot of times what might cut the taxes for one person don't cut them for another person. We're speaking in broad swaths of people and the majority of people. Along with that became one of the important impacts of the Tax Cut and Jobs Act, which was the standard deduction. The standard deduction has also been made permanent. This is what saved most people we saw income taxes with the Tax Cut and Jobs Act. And not only is it being made permanent, but it's also putting an annual adjustment for inflation. So that's big news for most people. But there's one thing that changed in here, which is called the SALT deduction. The SALT stands for state and local taxes. This was the most controversial part of the Tax Cut and Jobs Act. It capped this at $10,000. Now, if your standard deduction, if you're married filing jointly, was $31,500 for 2025. So if I only could cap at $10,000, I'd have to come up with a lot of other deductions. Maybe it's my mortgage, maybe it's charitable giving, to try to get above and beyond that. Where this really impacted was people who lived in high income tax municipalities. I personally live in the city of Pittsburgh, which has a 3% income tax on your income. That's one of the highest of any municipality in the Commonwealth of Pennsylvania. However, the Commonwealth of Pennsylvania is relatively, compared to some other states, low in income tax. There are some states that have no income tax. This is a really huge benefit for those who live in California and New York that have pretty high income taxes for their state tax. What's great about this for those people is that increase from $10,000 to $40,000 means that you can get up to $40,000, but that doesn't mean you have to have $40,000 of SALT to have this make sense. Maybe you have $20,000 of state and local taxes, plus you have $20,000 of charitable giving. You're now at $40,000, which is more than the $31,500 if you're married filing jointly, for example. The one important part to know about this is it's going to increase by 1% per year, and it only goes to 2029. At that point in 2030, it's going to revert back to $10,000 unless Congress takes a little bit more of action. So this is, I think, a really great provision to make everyone happy. It gave the increase for people that want to have the increase. It increased it within the ranges of what we kind of expected and saw from the different provisions, but it also still kept it capped. A lot of our clients find it's going to have little to no impact on them because they're probably going to take the standard deduction. So let's move on to the next important part of this bill. I keep hearing this, and we actually got multiple emails from clients. There's no tax on my Social Security. That is not true in terms of a statement. That might be true for an individual person. This has been really poorly done, in my opinion, by the Social Security Administration and a lot of politicians out there trying to make this statement. What they did was they added on an additional standard deduction for those that are 65 and older. But there's a problem with it. It has income limits, and it will slowly phase out. For a lot of clients, this won't even be something they can use because their income is too high between their pension, between the Social Security part that's at their taxable income, and between requirement distributions and taking other things out of their accounts. They might be above that and not get this additional standard deduction. That's not what this was designed for. This was designed for somebody that's living on Social Security to bring their standard deduction above the amount of somebody taking Social Security that doesn't have other income sources. So that's really what this bill was designed around for this provision, was to provide relief to people that are only taking Social Security. So for those that are age older than 65 and their modified adjusted gross income is less than $75,000 or $150,000 married filing jointly, this is going to be a little bit of an impact for you. As with anything, if you want to know what this impact is, and you're one of our clients, or if you're a potential client, you want to discuss it through, what we do for our clients, we actually will take their tax return and we'll use sophisticated software to mimic these new tax laws and show you exactly what it would look like if your last year's tax was based on this year's laws. The next provision in this law that we need to discuss is the estate and lifetime gift tax exemption amounts have been increased. This is the one you probably heard the most about in the news. This is the one a lot of financial planners were paying a lot of attention to. And one of the things that the Tax Cuts and Jobs Act did back in 2017 is it majorly increased the estate lifetime gift tax exemption the whole way up to $14 million per person roughly and $28 million per couple with portability in 2025. Had this legislation not been signed and gone through, it was scheduled to reset to roughly $7 million per person in 2026. So about roughly half. Under this new legislation, the estate tax exemption is now permanently, again, not going to sunset this one, permanently increased to $15 million per person roughly and $30 million per couple starting in 2026 and will continue to be adjusted for inflation moving forward. These are one of the parts I love about this. So much this was permanent and so much this was adjusted for inflation. Well, I want to point out, when it's permanent, that doesn't mean Congress can't take action. Elections have results, and based upon how the next election goes, the other Congress could come in and they could overturn this. But that takes inertia and it takes action. A lot of times to get things through, we put these sunset provisions in there, and that allows us to not know what to expect. That uncertainty makes your job for planning very, very difficult. So we saw a lot of permanent provisions in here. Next, let's talk about the qualified business income deduction is now permanent. If you're a business owner like myself, this was a great boost for us. So the qualified business income deduction, which was originally introduced in the Tax Cuts and Jobs Act back in 2017, has now been made permanent with the deduction rate remaining at 20%. This deduction is subject to income thresholds and other restrictions. So really, really important. If you're a business owner, you need to look at how this impacts you. This is one that I thought was interesting, as the personal car loan interest is now sometimes deductible. So for the years 2025 through the years 2028, car loan interest, now this is applicable exclusively to new vehicles with the final assembly completed in the United States. Plus there's a few other restrictions, but it's now deductible up to $10,000 per year. This is what's interesting, I think, about it. That all kind of makes sense. President Trump's talked a lot about this America First agenda and bringing manufacturing back here. So that part kind of seems to make sense in this bill, but this is the part that I think is interesting. The deduction phases out for modified adjusted gross income above $100,000 for single filers and $200,000 for married filing jointly. And the fact it was only 2025 to 2028, I thought was just kind of interesting, especially saw how this bill went through the different chambers. This interest deduction appears to be applied equally across all vehicle types, including electronic vehicles. We kind of didn't know how that was going to pan out with President Trump and Elon Musk and some of the fights they were having back and forth. But I also thought that this was really interesting, is there's no need, this part really I thought was peculiar, to itemize to qualify for this deduction. So this wasn't going to be something that we're going to put in itemized deductions. This is just a straight deduction to really encourage you to go out and purchase a new vehicle and purchase an American assembled vehicle. This is another big part of this bill. The electronic vehicle tax credit is being eliminated. So this is a credit that's been utilized a lot. You hear Elon Musk talk a lot about how Tesla used this. A lot of different vehicle makers started to convert to electronic vehicles. This is actually going away. Under the previous legislation, you had a potential tax credit for up to $7,500 for new electronic vehicles and $4,000 for used electronic vehicles. These credits will be eliminated for purchases made after September 30th of 2025 unless extended by future legislation. So, this is the big part of this. If you're thinking about purchasing an electronic vehicle, you want to do that before September 30th. You probably can bet that a lot of these automakers are going to be aware of that, and they're going to get a lot of sales and a lot of things to move that inventory out the door. So again, if you're planning on purchasing an electronic vehicle, highly encourage you to do it by September 30th, 2025. And the last provision I want to cover in our small, beautiful summary is what is being referred to as the Trump accounts. When they first came out, you heard a lot called MAGA accounts. But really one of the reasons why we call them Trump accounts in the final legislation, this window of people being born is literally only aligned with Mr. Trump's current term. So it's going to be 2025 through 2028. What this does is it gives a $1,000 contribution from the U.S. government to children who are born again through 2025 and 2028. They have to be assigned Social Security numbers as well to get this. There's no income criteria. So this is every child born in America during this time period. One of the interesting things that came up, and this was something I followed a lot, and I also voiced my opinion to a lot of legislators, because originally these are going to be some kind of quasi-separate account. And if you have 529 plan and you have UPMA and you have these Trump accounts, if we're calling them that, which one do I contribute to? It creates confusion. Confusion reduces clarity. Without clarity, people don't make decisions. They don't take advantage of the tax code. So what this did was make me have a little bit more job security and make my clients have less success. So I was a pretty vocal critic of that part of it. But what I loved about this is an entire generation gets to view the miracle compounding of interest. And they took out the provisions that said you had to spend this money. What they say is you can't touch this money to 18. So if nothing else happens, you're going to have an entire generation that gets $1,000 in an account that hopefully grows tax deferred till they're 18. That is beautiful, because when you see the power of how $1,000 grows, that might change your psychology, especially for those that never had access to a single person saving a dime for them, unlike a lot of middle class to upper middle class to the wealthy that had that privilege. Love that part about it. There's a lot of unknowns for this. One of the things that came in the final legislation I also loved is it says it has to be an indexed equity account. So the miracle of compounding over 18 years, the government's forcing them to put this into compounding into index, low-cost equity funds, which I love. Hopefully this gets people excited about some privatization of Social Security and some other things that we could do. But what's interesting about this is this only aligns with President Trump's term unless Congress enacts in this. This is also one of the controversial provisions because the government has to pay for this, right? So we are in a budget deficit. This bill is increasing the budget deficit. So this is an interesting part of this provision. What we don't know a lot about is where will these accounts be held? What indexes? It's said like an S&P 500 fund. If you actually read through the entire bill, there's a lot of unknowns about this. A lot of people are saying this is going to be inside of an IRA, but it didn't say that. We don't know. It looks like you're going to be able to convert it to an IRA in 2018. So also an interesting part about this is to encourage parents and family members and employers, parents, family members, and employers, you can contribute additional funds. So the child gets $1,000 in there, and you can contribute up to $5,000 per year. There's going to be no tax deductions for those contributions, but the child can have that grow as tax deferred. Also, interesting part about this, up to $2,500 per year can be provided by employers that won't count as taxable income. So it's going to be interesting to see how employers adopt this. It's going to be also interesting because it's only a certain segment of the employees that, you know, if it's 25 to 2028, well, I just had a child born on that time period and I got an additional $2,500 tax-free. How does that feel to your other employees as a benefit? It's a very, very interesting part of this. I think the most peculiar part of this, the part that I'm the most interested in, the part that I'm going to spend a lot of time talking to my legislators about, is these quote-unquote Trump accounts. Hopefully get a better name than that. If you want to know how this breaks down, you want to know how this impacts you, reach out to us. We'd love to talk to you. We are not tax advisors. We don't do tax returns. We're tax planners. We're CFP professionals. And what we need to do is we have to understand how the tax code impacts you, which ultimately impacts your financial plan, Because what we do is we help educate and empower our clients to make informed decisions. And it's really difficult to make informed decisions if you don't understand the rules and you don't understand the tax provision. If you'd like to talk, drop a note in the comments, give us a call. We would love to talk to you and help guide you.